Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation. Practical question 7. Following information are available in respect of XYZ Limited, which is expected to grow at a higher rate for 4 years, after which growth rate will stabilize at a lower rate. So they are given revenue, EBIT, capital expenditure, depreciation, and information relating to that. We have the growth in revenue and EBIT, then growth in capital expenditure and depreciation, and risk-free rate, beta, and market risk premium. These three will be helpful in calculating the expected return as per CAPM, so KE, and growth rate. Then pre-tax cost of debt is there, so we need overall cost of capital, right, for calculation of value of firm. Because the requirement is value of firm. Okay, then debt equity ratio is given. Okay, then working capital is 25% of revenue, they have told, and corporate tax rate. Okay, by seeing the requirement and the given information, we can see that we have to use free cash flow to firm method. Free cash flow to firm divided by the capitalization rate, which is nothing but KE or KO in our case here. But growth is involved, and we need projections, because they have given these growths at a higher rate of 4 years, after which it will stabilize at a lower rate, they told. So there are two rates here. One is high growth and then stable growth. So high growth will be for 4 years and stable growth from there on. This is like a same question which we have seen in our previous mm, which is same as this practical question 3, which we have detailedly solved this problem. So I suggest you to go and see this video, then come back here, because it's the same model, but here the growth it's stabilized, and then there is no extra growth here. It is same as the third year. So the problem solved, we solved this problem with that itself. But here there is an extra stable growth of 10%. Okay, we'll see what it is. Fine. Okay, as we've seen, where they have asked the value of firm, and then we have information for free cash flow to firm, and we have information for KE, we have information for the growth rate is already there. So 4 years projections we have to make, 4 years future cash flow we have to find out, then we have to discount it to the present value terms, and the stable growth signifies the terminal value. In the terminal value also we have to discount it to the current year terms, then that will be the value of firm. The discounted free cash flow to firm will be the value of firm here. For that we need a PAT. So the formula for free cash flow to firm is nothing but the PAT, profit after tax, minus the capital expenditure, and minus any working capital addition. um, yeah, working capital they've given 25% of revenue, so that will, working capital changes also will be reduced from the PAT to get the free cash flow to firm. So free cash flow to firm is nothing but the free cash which is available to all the equity shareholders, debt holders, and everybody, after meeting the basic working capital expenditure, the fixed the capital expenditure and everything. What is the free cash available for the equity shareholders and debt shareholders? Okay, first we'll find out the discount rate, because these free cash flows are in future terms. We have to discount it to bring it to the present values. um, okay, for that first 4 years it will be in a high growth, so it will be discounted at this the rate which we are going to find out now. When there was a high growth, we have information of risk-free return, equity beta, and then risk premium. Using that we can find out the KE. So we have find out the KE is nothing but 16.9% in case of high growth rate. and we know that pre-tax cost of debt is 13 percentage. So we have to reduce the tax percentage, which is 30, to arrive at the post-tax cost of debt. So 13 percentage minus 30 percentage will give us the KD. So in our case it is 9.1 percentage. Then in the case of high growth, the debt equity ratio is 1:1, so it is in equal proportion. Same way, if we apply to the cost of overall cost of capital will be 13 percentage in the case of high growth. This 13 percentage we will be using to discount for first 4 years. After that, it will stabilize at a lower rate. So the stable growth rate also we have to find out now. For that, we have again risk free rate, and then equity beta, and then market risk premium. We can find out the KE using these values, this CAPM method. So 14 percentage is the cost of equity, and cost of debt, again same thing. This is pre-tax cost of debt. So if we reduce tax percentage, we'll get the cost of debt, so which is coming up to 9 percentage. Okay, then going further, we have weight of 2:3 ratio. So in this, again we will be finding the overall cost of uh, capital. So the formula will be KEO equal to KE multiplied by E plus D, then KD multiplied by D by E plus D. Here this KD is post tax cost of debt, which we have already found out here, and E by E plus D is nothing but the weights here. So 2:3, that means 2 divided by 2 plus 3, then 3 divided by 3 plus 2 plus 3, which is 5. So same they have found out, same ratios they have followed to calculate this cost of capital, overall cost of capital, 12 percentage. Okay, so the terminal cash flow will be discounted in this 12 percentage. Okay, now the next step is finding out free cash flow to firm. For that we need first PAT. So first we'll be taking the first year data, which is the base here. So using this base, then we have to add the growth to find out the 4-year cash flows. So this base will be nothing but the year 0, the current performance, the current performance of the XYZ Limited. So revenue is 2000 crores, and then EBIT is 300 crores. So yeah, and we know that the growth is 20 percentage, so 300 plus 20 percentage will be 360, and 2000 plus 20 percentage is 2400 in case of year 1. Then adding 20 percentage for 4 years, we have to add 20 percentage to both revenue also and EBIT also, to get these values 28803456 4147.2. Then the 360 plus 20 percentage 432 518, then 622.08. Okay, then on this, if we reduce taxes, so taxes around 30 percentage, so EAT is nothing but 70 percentage of our EBIT. 70 percentage of EBIT will give us the earnings after tax, so which is 253, 302.4, 362.88, and 435.46. And the terminal value, we know that the rates and everything is changing, so we have to be very careful. It is 10 percentage growth, so 4147.2 plus 10 percentage is 4561.92. The same case, 622.08 plus 10 percentage will give us 684.29. Here also the tax rate remains same in both the cases, so for all time tax rate is same, and even the working capital changes. So 30 percentage tax rate, so 479. Now capital expenditure, in case of the first 4 years growth rate is, they have told it is 20 percentage growth rate. This capital expenditure is nothing but the capital expenditure 280 minus depreciation, which is 80, the net capex. This 80, we are assuming that the asset turnover ratio is remains same. So considering that, considering that, whatever the revenue increase in percentage will apply here. Oh, sorry, they've given growth in capex and the debenture is 20 percentage only. So whatever here we found out, we have to just add 20 percentage. Yeah, sorry for that. So 80 plus 20 percentage will give us 96 in case of first year. Then 96 plus 20 percentage is 115.2, and 115 plus 20 percentage is 138.24, plus 20 percentage is 165.89. Okay, now this is that capital expenditure minus depreciation. This has to be reduced from PAT. Then whatever changes in working capital also has to be reduced from PAT, which is nothing but 25% of revenue they told. So 2500 2400 multiplied by 25% is coming around 600. 1 minute. So the increase in working capital is nothing but they have told working capital is 25% of revenue. So first we have to calculate increase in working capital. So working capital changes will be, first the existing base one is 2000 multiplied by 25% is 500. Then in our case revenue is 2400. 2400 multiplied by 25% is 600. So if you see the 600 minus 500 is 100. That's what is changes in working capital. That's how we have to calculate changes in working capital. Or else the difference in revenue multiplied by 25% also will give us the same results. So we know that 2400 minus 2000 is 400. 400 multiplied by 25% is 100. The same way 2880 minus 2400 multiplied by 25% is 120. Same way 2456 minus 2880 multiplied by 25% is 144. Hence we are the increased in working capital is 100 in case of year 1, 120 in case of year 2, and 144 in case of year 3, 178.8 in case of year 4, and terminal is 103.68. Okay, here also same case, 4561.92 minus 417.2 multiplied by 25%. They, because they told for all time working capital is 25%. So irrespective of the terminal or the first 4 years, the increase in working capital is same. Reducing this to the PAT will give us the free cash flow to firm. So 56 in case of year 1, 67.2, and then 80.64, 96.77, and terminal year is 375.32. Now for the first 4 years, the individual free cash flow is these numbers 56, 67, but terminal year is this 375.32 is for from fourth year till the end of the business. That's what is the assumption, till eternity. So this 375.32 is the cash flow which we are generating. Now we need to get the terminal value, so we'll be dividing it by the um, additional cost of capital, or reducing with the growth. So which will be nothing but the cash flow which we found out divided by KE minus KG, KE minus growth rate. So in our case, the KE which we found out is 12% for the stable growth. So minus the growth rate is 10%, and 375.32 divided by 0.02 will give us the terminal value, which is nothing but 18,766. Now this, if we discount it to the current terms, will give us the present value for the terminal value. So we have to discount it for 4 years. So fourth year discount rate for 13 is 0.613, so 11,503.56. And the other cash flows whatever we found out, we have to discount it by the 13% cost of capital, and that comes up to 217.38. Adding this two will give us the value of the firm, so 11,720.94. Thank you.